at the SAPICS conference, Luca and Emil will be doing a presentation and a workshop. So I'd also like to just acknowledge that we have a new arrangement with Supply Chain Finance as an affiliate partner, and it's very exciting for us to have this relationship. And as we all know, the connection and synergies between supply chain finance and finance departments is very important. So it's a great relationship for us to have, and also to have Addendum as a partner, a sponsor at the conference, and hopefully we'll have more engagement with them going forward. So those are the thank yous. I'd just like to quickly introduce our two speakers. Emil Schoeman is the co-founder and managing director of a global award-winning business, Addendum Financial Technologies. It's a leading provider of supply chain finance services in Africa. And before that, he was an executive director at Morgan Stanley. And Luca is the head of the supply chain finance community, and that's how we connected. But when he's not doing that job, he's an assistant professor at the University of Groningen in the Netherlands. And he's been part of the supply chain finance community since 2018. So they're very experienced people, and it's great to have them speak to us this afternoon. So with no further ado, I will hand over to Luca, who will start the webinar. And please feel free during the webinar, if you have a question, you're welcome to put your hand up, and I'll keep an eye on the chat with that. Alternatively, we'll have some time at the end for discussion and questions. So thanks to you both. Thanks to everybody for joining, and over to you, Luca.
Thanks a lot, Claire. Welcome, everyone. I'm very happy to be here today and to talk about supply chain finance. As a sort of teaser for the main conference in June, I very much look forward to be there and to discuss supply chain finance in that setting. Without further ado, let's just get into the topic. The objective today is to get a general overview of this kind of mysterious topic of supply chain finance. So what are we talking about? What is it? Why is it relevant for companies in Africa or everywhere else in the world to talk about supply chain finance? As Claire has nicely introduced me, I work at the University of Groningen in the Netherlands, and for the SCF community, I'm a researcher and academic, and supply chain finance is my main topic. But the SCF community is actually a broader foundation. It's a not-for-profit organization that is somehow similar to SAPICS, and that connects universities and corporates in the field of supply chain finance. So we connect universities everywhere in the world that are interested in supply chain finance with the corporates that use supply chain finance on a daily basis. This slide is a bit old, but it's just to give you a general understanding of our structure. We work with academics and corporates in order to advance the knowledge on this topic of supply chain finance. So what do we talk about today? Well, we talk about supply chain finance. I'll do my best to give you a general introduction, especially not going into the technical details, but to give you a general understanding of where does supply chain finance comes from, seen from the perspective of a supply chain professional, because I do have a background in logistics and supply chain management. So although I worked on supply chain finance for more than 10 years, that is where I come from. And this is the language that I still speak. So I will try to walk you into supply chain finance, doing the same journey that I have done, starting from the supply chain. Then I will leave it to Emil to give us a different perspective and to drill down on South Africa and the African context. And I will then take it back for some conclusions at the end. At any point, if you have a question or if you have a comment or anything, feel free to interrupt me. I do not mind. If you want to make it a conversation, I'm more than happy to do so. So where do we start? Well, you all know the concept of a supply chain. I don't need to explain you what that is. What I want to highlight is that we think about supply chains in terms of the physical flow, the flow of materials that go around this global, dispersed, fragmented network of companies, from extraction of materials from the earth down to consumption of products. But together with a physical flow, there is a financial flow that goes the other way around, from consumption of products upstream in the supply chain. And in the same way as we manage the physical flow, it is also relevant to manage the financial flow. And in the same way as we optimize the physical flow at the supply chain level, it makes sense and there is value in optimizing the financial flow at the supply chain level. Sometimes to help students understand what I mean, I show this slide as a sort of provocative message. If you think about the physical flow, delivering, ordering, the invoice processes, we have made huge progress in, let's say, between the 60s and the 2000s in terms of improving the physical flow. We have Amazon or Alibaba or whatever it is that delivers in one day, but on the financial flow, we still struggle with payment terms. And we, generally speaking, have tensions and conflicts on when to get paid and how long it should take to get paid. That signal the need to somehow do better on the management of financial flows across global supply chains. And this is essentially what we do when we talk about supply chain finance. This is not something that only small companies think about. This is how large companies, giants of the world, think about. And this is more relevantly for this community. This is how supply chain people think about nowadays. Again, when I talk with my students about supply chain finance in my supply chain management course, I do talk about Apple. And why do I talk about Apple? Because Apple changed their strategy several years ago to move towards using their supply chain to improve financial management. And one way in which they did that was that they minimized their cash-to-cash cycle. So they reduce inventory throughput. So they reduce the time in which they own the inventories. They increase payment terms towards suppliers and reduce payment terms from distributors so that they increase the cash flow that they could get from their supply chain. This was something driven by Tim Cook, which was the operation director. It was the supply chain guy within Apple. And when Tim Cook took over and gained his primal position within Apple, the main strategic decision that he took was to reduce the cash-to-cash cycle as much as possible in order to use the supply chain of Apple to generate value, to, again, reduce the amount of time in which Apple owns inventories, increase payment terms to suppliers, and reduce payment terms from distributors. So when I'm talking about improving the financial flow at the supply chain level, I'm talking about something that Apple did over a period of 20 years. So it's a huge amount of values. But of course, there is the other side of the coin. Squeezing suppliers, so extending payment terms as much as possible, might not necessarily be the best thing to do for your suppliers. And if you are a supplier of a large company, like a supplier of Apple, you might not necessarily like this idea of getting paid very late. And we have seen after the financial crisis of 2008 and 2012 that extended payment terms created problems within supply chain, created financial issues for suppliers that had to face long payment term extensions. And we have seen the same during COVID in the past years. We have seen suppliers suffer because of long payment term extensions. That is an issue because if you want to extract more cash flow from your supply chain and you do that by pushing inventories to someone else or increasing payment terms to someone else, then that someone else will extract less cash flow from their supply chain. So the supply chain is an interconnected network of companies. So every decision that you take from a financial perspective will have repercussion across the supply chain. This is especially important to discuss today because we are in a sort of strange situation. Again, this is one of my typical slides with my supply chain management students. I show them the cost of capital for very large companies that can get an AAA bond. And you can see the cost of capital in the top, the dark green line. It's, as we said, it's inverse. So short-term bonds, so short-term loans that are repaid in the short term cost more than loans that are repaid in the long term. That means uncertainty. There is a lot of uncertainty. As a supply chain management, as supply chain manager, you should be familiar and you should be aware that there is a lot of financial uncertainty, and every decision that you take from a financial perspective from your supply chain, paying later, moving inventories and so on and so forth, will have repercussions on your suppliers and on the uncertainty that they feel and on the cost they will have to face. This is essentially what supply chain finance is. It's the integration of supply chain management, the physical flow with the financial flow. It's to increase awareness and highlight the overlap between managing the physical and financial supply chains and finding collaborative solutions to manage together this idea of paying inventories and cash flow out of the supply chain and come up with a collaborative way to extract value from the supply chain, to extract cash flow from the supply chain. How to do that practically? And I'm moving towards the conclusion of my starting point. How do you do practically? I'm just giving you one example, which is the most common way to do this on a practical level, which is reverse factoring. In reverse factoring, you have a large buyer like Apple or Procter & Gamble or Heineken or whatever, with a lot of smaller suppliers. And those smaller suppliers want to get paid fast, and Heineken or Apple maybe do not want to pay right away or do not want to pay all of their suppliers very fast. So what can they do? Well, they can work with their own provider, whether it is a bank or an SCF provider or a technology provider, in order to come up with a collaborative way of managing those payments. For example, they can approve invoices. So they can go to a financier, to the bank or the SCF provider, and they can tell them, well, okay, I received an invoice today from my supplier, and I can confirm to you that that invoice is correct. And I will pay this invoice in 2 months or 3 months or 4 months or whatever it is, the payment terms that we have with that supplier. This financier, with the strength of the supply chain, with the strength of this confirmation of the invoice, can actually pay the invoice in advance to the supplier at very, very limited financial cost, because the risk for the financier is very limited, because they have received the guarantee from the buyer that the invoice will be paid. In this way, you have the power of the supply chain that is used to create value for all the companies. The buyer does not have to pay right away. They can pay with longer payment terms, which is their objective. The supplier gets the money very quickly from the financier, and they do not have to pay high interest costs, because they can basically use this approval of the invoice. They can reduce the risk by having this approval of the invoice from their buyer. And both of these players then can create value by using their supply chain relationship. This is not the only way to do supply chain finance. There are several different ways to do something similar, and we're going to discuss some of them later on. But essentially, this is the main idea, using the strength of the supply chain to create opportunities for better management of financial flows. And usually companies with whom we talk do this for 3 reasons. One is to improve their supply chain, either to become more responsive or become better at manage risk. If my suppliers have less risk, so myself as buyer have less risk. If I give supplier access to credit, if I facilitate access to credit, then my suppliers have less risk. They do that to improve their own financial performance. So, for example, to extract cash flow by paying the bank a bit later than what they would pay otherwise, or they do it from a relationship and responsibility perspective. So they want to improve, for example, their image by saying, well, we help our suppliers into accessing liquidity, and we are good buyers that take care of their own supply chain. No matter what is the main driver, the idea remains the same. You help your supply chain in creating value by better managing the financial flow across the entire supply chain. And if you are asking, okay, but how common is that? It's a relatively common thing. We have statistics on the adoption of reverse factoring across large companies, 5 billion, 1 billion and more, so 1 billion or more of revenues globally. And we do see that around 1 out of 3 companies that have a revenue of 1 billion or more do have this program in their supply chain. So do have reverse factoring for their suppliers. So we are talking quite a substantial amount of companies. And probably below the 1 billion, there are even more companies that offer this. And you can see the bigger the company, the more likely it is that they have this program offered to their supplier. So it is a relevant thing because a lot of companies are doing it. It is a relevant thing because we are in a setting right now, geopolitically, financially, in which there is risk and uncertainty. So there is more need to help your suppliers. And therefore, it makes sense to have a conversation about supply chain finance. What does it mean? How does it help companies? And how does it get applied in different contexts? But I would say to discuss the reality of supply chain finance in South Africa specifically, then I'm happy to leave it to Emil to give you a bit more details. Emil, please.
Perfect. Thank you so much, Luca. And thank you to the SAPICS people for putting this presentation together. Just very quickly, I'm just going to share with you, what we do at Addendum. Like Luca said, we are the people on the ground that essentially that create practical supply chain finance solutions for large companies in Africa, as well as for all of their suppliers. So just very quickly, I don't want to spend too much time on our footprint here in South Africa. I think basically, we always joke at the business, we're probably the biggest arranger of finance that nobody has ever heard of in South Africa. So over the last 12 months, we funded about 80 billion rand of supply chain finance invoices over our platform. That funding is facilitated predominantly by the 5 biggest banks in South Africa, but there's other funders on the rest of the continent. In the global context, Africa is still very new when it comes to supply chain finance. I'll talk a little bit later about Africa, but in some countries, we will literally launch the first digital supply chain finance program over the next year. 2 years ago, we, for example, launched the first digital supply chain finance program in Namibia with the Oceana Group. So this is pretty much pioneer country as far as supply chain finance is concerned compared to the rest of Europe. So if I look at Luca's graphs in terms of penetration and what percentage of companies are offering supply chain finance, I think the percentages are significantly lower, but it is growing much faster than the rest of the world, obviously, coming off a really low base. We've implemented more than 50 of these programs now. So our business is about 10 years old this year. So we've implemented more than 50 of these supply chain finance programs in South Africa. I think, it's different companies work at different speeds. So we've done this in less than a month, and some companies take about a year or longer to actually launch their programs. But we've managed to win 8 global awards. So the South African companies or large corporates are really coming to the party when it comes to supply chain finance, and actually giving the benefit not just to the bigger suppliers, because often the temptation is, listen here, let's give our bigger suppliers the benefit of supply chain finance. They in turn give us better payment terms, and we both win. And that's where the programs stop. But I have to say that the South African companies, especially when it comes to social awareness in terms of spreading the benefit all the way down to SMEs, you can see in terms of the number of suppliers on a lot of our global award-winning programs, you can see that the number of suppliers is extensive. You can look at Dis-Chem there, for example. I mean, Dis-Chem they have more than 600 of their suppliers on their supply chain finance solution. So that implies that that's pretty broad-based. You know, most of the companies in South Africa focus across the board, across the whole supply chain. Just very quickly, I just want to discuss, you know, some numbers here quickly. In terms of supply chain finance volumes, you can see this is our volumes sort of since inception. You know, you can see that little red circle there. That was the COVID period, which obviously had quite a big impact as manufacturing sort of ground to a halt in that period. But generally, supply chain finance has grown about 40% per year in South Africa, and I think that's probably true for most of Africa. As I mentioned, we have 6 South African banks, so the top 5 banks plus the IFC is funding supply chain finance programs in South Africa. We have more than 50 of these programs and thousands of suppliers supplying goods and services into these 50 large JSE listed and multinational companies. So we've essentially funded over 300 billion rand of invoices. So that's for the benefit of suppliers. So over 300 billion rand of invoices have been liquidated on our platform for earlier payment. And the real benefit, as Luca mentioned, is the cost of these invoices. So more than 98% of the invoices have been funded at less than prime, right? So the South African prime rate, which right now sits at 11.75%. So most of the suppliers, these thousands and thousands of suppliers, have been able to get access to funding at a very, very low rate. In other words, rates that they would never have been able to get from the bank. And they managed to get that through the solution. It's not just local suppliers, so 30% of that funding is in non-rand denominated currency, so for foreign suppliers. And the reason why foreign suppliers, and you know, this is very important for the corporates in South Africa. Corporates often find it difficult to negotiate good payment terms with foreign suppliers. And supply chain finance becomes a critical aspect of that. You know, foreign suppliers do not want currency risk. They do not want South African country risk often. They don't understand the, you know, the creditworthiness of our corporates. So they typically ask for immediate or cash payment terms. And supply chain finance now allows corporates to negotiate better payment terms, even with the foreign suppliers. So our clients in South Africa that have onboarded foreign suppliers onto their programs have managed to extend their payment terms by 60 days or longer. So that's a huge benefit for large South African corporates. At any point in time, we are implementing 5 new corporate programs. So that's for the corporate and all of their suppliers at any point in time. So I just wanted to give you a sort of a view into what's happening in South Africa. Because there's a lot of procurement professionals on this call, I thought I'd just sort of share this with you. You know, this is essentially the creditors' days. In other words, the average payment terms with suppliers for 6 of our FMCG customers in South Africa. The blue customers are South African listed large corporates. So they're listed on the JSE, the blue ones. And the green ones are multinationals, multinational FMCG companies that have implemented supply chain finance programs in South Africa. Now, a CFO that sits in South Africa and he compares his payment terms, right, to his multinational peers. In other words, people that are competing with him in South Africa, but that are multinational companies will look at this. So the 2 companies on the left there will look at this and say, listen here, my payment terms are out of sync with my international competitors, people that are competing in South Africa. How do I, you know, increase my payment terms so I can be more competitive? From a working capital perspective, I can perhaps be working capital neutral or not as negative. And how can I generate some working capital so I can expand my operations and invest in my infrastructure? So these 2 guys on the left, as I mentioned, both Addendum clients, but they're brand new clients. Their target is, how do I get my payment terms to 90 days? And I'm sure a lot of procurement people do have this pressure from the financial guys to say, guys, listen, you need to improve our payment terms. It's busy eating up our working capital. And that is really where Addendum, where my organization plays a major role. We have a consulting team that assists procurement in helping them to get these better payment terms in place. So how do you successfully negotiate better payment terms? But like Lucas said, how do I then not put my supplier under financial pressure? Because the financial sustainability of your supply chain is critically important. If one of your strategic suppliers go bankrupt and they cannot deliver their goods and services, it could have a major impact on your business. So supply chain finance is there to support your suppliers. It allows them to get paid on day 2 or 3, depending on how long it takes you to process an invoice, so they can decide when they want to get paid. And on the other hand, you can negotiate payment terms that are more aligned to your competitors or your peers in the market. So that is supply chain finance. It essentially fills that gap between when a supplier wants to get paid and when you would like to repay a specific invoice. So I just want to mention this SA-listed company. They've been a customer of ours for 4 years now. So we've managed to standardize their payment terms and get them in line with some of their international peers. So very important. And it also means we have a very good idea of what payment terms should be across various commodity buckets and so on and so forth. So that is the benefit for the large corporate typically. It could just be a social angle where you don't need to extend your payment terms, where you just make your funding lines available to your suppliers. But typically, most corporates want to get their payment terms aligned with their international competitors. And then you also give your supplier a huge benefit of a cheap funding line. I just want to mention this corporate on the far right-hand side. They do not offer supply chain finance, and they have average payment terms of 239 days. So you do get this, and in our opinion, that's irresponsible. And some people would say totally unethical, but you do get those sort of payment terms as well. Not a client of Addendum, by the way. Okay. Okay, so that's sort of just in terms of benchmarking. I would like to quickly share with you what we're doing in the rest of Africa, right? I think this is quite well known and well published that there's a $2.1 trillion funding gap for SMEs around the world. In other words, that is where suppliers have to wait for payment on their invoices, so a massive trade finance gap. They say globally, 45% of SME funding applications, and I'm talking about direct funding applications, with the bank is typically rejected. I would say in Africa, that number is much closer to 70%. SMEs are very much underbanked in South Africa. So there is a huge opportunity to provide more funding to these SMEs through supply chain finance. And the reason for that is not a single SME has ever been rejected for accessing supply chain finance. Why? Because the funding line, it's a funding line that's been put in place by the large corporate, the buyer of the goods and services. It's their funding line. They make it available to their suppliers to use. It's a very simple, it's an electronic registration and onboarding process. So there's no bank vetting of the supplier. No supplier has ever been rejected. And as I mentioned earlier, the funding rate that the suppliers get is extremely low compared to their existing funding. And as I mentioned here, in some cases, suppliers cannot get any funding at all. So we believe in Africa, the funding gap is even bigger in terms of percentage. The blue countries that we've indicated is where we are live. The green countries is where we are currently implementing supply chain finance. And in most of those countries, that will be the first digital supply chain finance solution in that country ever. And then in the orange countries, we've engaged there with certain bank partners and or certain existing customers. So as I mentioned, 2 years ago, we launched the first ever digital supply chain finance program in Namibia with the Oceana Group. I think the local entity there is called Irongo Marine. In Tanzania, we will be launching the first supply chain finance digital solution with Vodacom, with a number of the local banks there. Same in Mozambique. We're just waiting for central bank approval, along with Vodacom. So those will be the first supply chain finance programs ever in those countries. In Nigeria, we are already live with one large buyer and I think over 60 of their suppliers. And we have other customers that want to launch supply chain finance programs in those countries. Uganda, we are live there with, or soon to be live with, one buyer, one bank already live. And then in Ghana, we also have that same bank live. Kenya, busy working with 2 banks to cover an existing client, and the IFC, who's a big supporter of supply chain finance because it has a big developmental aspect to it. They have a client in Guinea, essentially requiring supply chain finance. So that's as far as the African footprint is concerned. Maybe I should just give it a pause there and see if there's any questions from anybody out there.
Yes, thank you. Thanks for that. Great.
Yep.
Just after Luca had finished, Carol's question, how do you prove, in inverted commas, the strength of your supply chain?
I think that relates to the approval of the invoice, if I understand the question correctly. So the idea of what I was saying before was that so the buyer basically approves invoices, and by approving invoices, it allows suppliers to access credit at a much lower cost, as Emmanuel has shown. And this is what I mean with the strength of the supply chain. So if you take Omnia in South Africa or Heineken in the Netherlands, most of their suppliers will not be financially strong as Omnia or Heineken. But if Omnia goes to a bank in South Africa and says, well, this invoice is correct, and I confirm that I will pay in 60 days, then this transfers the strength of Omnia to its suppliers, and this is the mechanism that allows the supplier to pay very little for that invoice.
Yeah, we've got dozens and dozens of these testimonials from suppliers. So I just want to add a few points here. I can use one of our local apparel companies that appeared on the front slide. So they wanted to double the orders for a South African clothing manufacturer because they wanted to start after the COVID period. They wanted to onshore a lot of their manufacturing, but the local clothing supplier didn't have enough capital to essentially expand their plant to produce more clothing. And essentially, by making supply chain finance available to the supplier, they could liquidate all of their invoices immediately. They used that capital to double their plant. They could produce more. They could employ more people in that plant. It was really a massive success story. I think they employed another 67 people in that specific clothing line. And by delivering it and getting their invoices approved within 2 days, they could essentially continuously liquidate those invoices to keep the operations running. So that's just one example of supply chain finance that it not only allows you to keep your existing supply chain financially secure, but it allows your suppliers to expand much quicker, right? So if you grow, your supplier will essentially grow with you. So it removes that financial constraint that often exists for suppliers, especially the SMEs.
Great, thank you.
Cool.
Anderson, we've got a lot of questions here. So Anderson, I don't know if you've read that, but we're currently working on the working capital financing facility for farmer distributors, and are very interested in learning more about this mechanism. But my question is more about how to balance the need for liquidity and profitability, especially when managing working capital for farmer distributors. Using debt factoring should improve liquidity in the supply chain, but but do we have any idea of its impact on profitability? And Jan has put a thumbs up there, and then he's put a link. So I don't know if Jan, when Emmanuel has answered the question, you may want to just step in there.
Yeah, I think I probably need a bit more detail, around the supply chain in their specific examples. I'm happy to talk to them offline. I mean, every supply chain has their nuances. What we see in the agricultural supply chain, for example, is that farmers want to get paid immediately, right? You cannot negotiate payment terms with farmers. They want to get paid immediately. So, for example, we have dozens of milk farmers, for example, on our platform that are getting paid immediately by the FMCG companies that are using that product to essentially create other goods. And then, even have solutions where the large buyer is willing to pick up the cost for the term, right? So you can pay the farmer immediately, and if you want to pay the bank back on day 60, the buyer can say, okay, I'm willing to pick up the interest cost for the 60 days. So there's various flavors of this, and there's not one correct answer or right answer or wrong answer. It depends a lot on the nature of your supplier, the history between the suppliers. Is a supplier strategic or not strategic, and is it a very competitive category, or is there one supplier only, and etc. But I fundamentally believe that you can find a solution regardless of who the buyer is and what your supply chain looks like, as long as there's a creditworthy buyer, at the top of the pyramid, if you want to call it that, right? So as long as we can get funding for the buyer from any one of the big commercial banks, and sometimes we can get it from non-commercial banks, then you can ensure that the funding flows downstream, right? An invoice is approved, the funding goes from the bank into the first layer of suppliers, and then you can implement more programs that goes down into the second layer of suppliers, and so on and so forth. So I know it didn't answer the question directly. It's a bit of a tough question to answer without having more details, but fundamentally, like I said, you can inject supply chain finance funding in most supply chains.
Sure. Well, if you're okay, I will share Addendum contact details with you, Anderson, and then you can pick it up with that. Jan, did you want to just comment on your link that you put in your chat?
Yes, why not? I think agricultural supply chain finance is an interesting topic in Africa. I did some research with the University of Knoest in Kumasi. And there's a big potential, to start with, to have a kind of pre-harvest financing, but it's in the starting phase. So I'm interested also to hear it from the colleagues from South Africa, how well they are doing, also in the agricultural field. But I think this is an opportunity, at least in one case study. I did some research in Ghana.
Great. Any comment there?
Yeah, I just want to mention, I mean, obviously, Jan, what supply chain finance focuses on, I mean, or supplier finance or reverse factoring, whatever you want to call it, we focus on the invoice side of things, right? So once there's delivery and the invoice has been approved by the buyer, at that point, it's sent to the platform and then it can be funded, right? And the reason we focus on that is because it's there's less risk for the buyer, because remember, the buyer approves this invoice, and by approving it, it's almost like a promise to pay. So once the buyer has received the goods or the services, they're happy to approve an invoice, and the funding rate on those invoices is really low because of that. Now, when you start talking about pre-delivery finance or inventory finance or even pre-shipment finance, I mean, the further and then you have order finance, which is even further up the stream, right? The further upstream you go, the more expensive funding typically becomes, right? Order finance being the most expensive. I just have an order and I need to start funding it, because the risk is pretty significant for banks and funders, because they need to make sure that you can deliver on this. There's a long lead time, there's inventory, there's order cycles, and so on and so forth. So that would be the most expensive. Inventory finance being a little bit less expensive, and so on and so forth. So I think for the purposes of this, we just cover invoice finance because it is post-delivery, post-approval by the buyer, and that is typically why it's the cheapest. Okay. But there are, I mean, to answer your question, there are order finance solutions out there. We do, for example, work with one company in South Africa where what we do is we get the orders electronically sent to our platform from large companies. That orders is then exposed to this company that funds the orders. So they would fund the order on behalf for the supplier. So they would order the goods, the raw material that goes into producing the goods and services, and so on and so forth. But that's almost like a separate topic for another day. But it does exist.
Great. We've got 3 more questions. Please keep your questions coming. It's great to have the interaction. Do you typically finance up to 100% of invoice amount, deducting fees and interest, or only around 80%, says Jin Chang?
Yeah, so definitely 100% plus taxes. So in South Africa, we have 15% VAT. So if you have 100 Rand of goods delivered plus 15% VAT, you can discount 115 Rand. So 100% plus VAT is discounted. You only pay for the number of days that you discount the invoice for based on the funding rate. There are no other costs. It's no cost to access the platform. There's literally no other cost. You just pay for the number of days based on the funding rate. And that's one of the biggest benefits that suppliers see in the solution. You know, typically, historically, with bank funding, suppliers would get between 50 and 70% of their debtors book could be funded. They had to provide security and often additional security. And then the lead times would often be weeks, where with supply chain finance, you get 100% plus VAT funded. You know, the lead time is 24 hours before you get access to your funding, and it's done at the click of a button. So you don't have to apply with banks, etc.
Great. Mike has 2 questions. Do you have any empirical evidence or otherwise that suppliers do not react to early settlement discounts by increasing the prices to buyers? How does a buyer deal with this potential threat?
Yeah, that's a great question. We get it all the time from our customers. We have a lot of empirical evidence on that topic, and we get it directly from suppliers. And the reason for that is simple, Mike. You know, when people, the discounting of an invoice, right, on a supply chain finance solution does not impact the supplier's gross margin or his revenue, essentially. Right, the discounting of an invoice is a financial transaction between the supplier and the bank, right? So the expense that is incurred in that transaction is a financial expense. In other words, it becomes interest paid, right? And that interest payable line item then goes below the line. So it doesn't impact your EBITDA, it doesn't impact your gross margin. It's a below the line expense. And second point is, that discounting, because it's a financial decision, is made by the CFO on the supplier side. It's not made by the commercial or the salesperson that is selling you goods or services. So that financial person will then sit there and compare the cost of supply chain finance with these other forms of funding, whether it's capital, borrowings, and other forms of funding. And in most cases, it leads to a saving for him, right? Because if you compare the cost of capital in South Africa is north of 20%, suddenly the financial person can get access to capital at sub 12%, right? Or in many cases, 10%. So it immediately leads to a saving on the financial side of the business. So to the extent, so to answer your question, to the extent that there's no impact on the financial side, there should be no impact on the cost of goods, right? Because as I said, it doesn't impact the margin. So the KPIs for the salesperson on your supplier side, if you negotiate longer payment terms with him, it actually doesn't impact his KPIs. His margin stays intact. His selling price stays intact. It's totally a financial thing. However, if you negotiate fixed discounts, so you get this concept of dynamic discounting where people want to negotiate a fixed discount for immediate payment, and the company pays the supplier directly. So if you negotiate, let's say, a 3% discount for immediate payment, that often comes back to you in increased selling prices or increased cost of goods. And we see this in the retail space a lot. In the retail space, there's often up to 6 to 10 different deductions, rebates, and so on. But at the end of the day, the supplier just does a calculation on top of whatever the rebates are to ensure that he achieves his margin. Yeah. So, Mike, I hope
Awesome.
that answers the question. Yeah.
Are pension funds and asset managers potential funders rather than banks? And can the system work without a bank infrastructure in the background? Good question.
It's a really good question. Typically, asset managers, I mean, the IFC is a developmental institution, so they're not an operational bank, for example. We do have asset managers that are funding this, but not as a primary funder. They typically do this as secondary funders, so they provide guarantees behind the scenes so banks can increase their funding lines. So the reason why asset managers and pension funds are not primary funders is the nature of supply chain finance means it's very unpredictable when suppliers will sell the invoices, because they have the option to decide, do they want to sell it today, tomorrow, next week, end of the month? So they don't like that from an operational perspective. It's quite operationally intensive. The banks are perfectly suited to deal with large number of flows and variable amounts. So operationally, the asset managers are not suited. And the asset managers need more predictable inflows and outflows as far as their funds are concerned, right? So they prefer to work on certain time periods and in certain amounts, and supply chain finance is not that. So they would often provide guarantees or pools of funding behind the scenes to banks, but they typically don't act as primary funders.
I'm not sure if you've still got some more slides, or are you done?
Yeah, I can just run through just a quick summary of the benefits for your suppliers, you know, because I mean, I think the benefits for corporates is very obvious in terms of the ability to negotiate longer payment terms, and as Mike, you know, very importantly, without incurring costs in future or in the form of higher cost of goods. The supply chain finance 100% online, right? So suppliers register online, can be done in minutes. There's no forms they fill in. There's no KYC with the bank. And that's why we say the barrier to entry for supply chain finance, as far as suppliers are concerned, is extremely low, right? Which makes it very accessible. This is the cheapest form of funding that a supplier can get, a SME definitely. So it's as simple as that. I can unequivocally say this is the cheapest form and the simplest form of funding that a supplier can get. As I mentioned, it results in a significant reduction in the cost of capital for a supplier. As I said, 98% of our funding is done at the subprime rate in South Africa on supply chain finance. The actual cost of capital in South Africa is north of 20%. Some suppliers that are desperate for funding, they fund their invoices at 5% a month in the invoice discounting market. So if you compare supply chain finance to rates of 60% a year, it's obviously, you know, you can't even compare it. There are no other fees for suppliers, right? Not a single other fee. It's just the cost of discounting. They can access their money within 24 hours, 3 clicks of a button, right? So in terms of simplicity, you cannot get any simpler than this. And as I mentioned earlier, 100% of the invoice value plus VAT can be funded versus 50% on traditional forms of debtors funding. We have all the banks on our platform, so that ensures that there's sufficient funding lines available. Some of our programs are up to about 4 billion rand. So you can imagine you need all the banks to cover those suppliers. And then often suppliers already, before they join supply chain finance, they have their debtors seeded to a bank. So the benefit of having all the banks on our solution is we can work with that supplier's bank to essentially unwind the session, right? So instead of getting 50% funding on their debtor under a traditional bank funding line, we can unwind that session, and now they can get 100% with that same bank. So that's one of the big benefits of having all the banks on our solution. And at the end of the day, if a supplier just wants to get transparency into all of his approved client invoices, which we believe adds a lot of value to his accounts receivable area, you know, that comes at no cost to them. And that's it. That's my story. From my side, I'm going to stop sharing and grab a drink of water.
Thanks
Thanks
very much.
We are very much
Any
on
other
time.
questions for Luca?
Maybe let me just maybe close it up, because I think there are around 5 minutes. So I just want to say, well, there is much more to say about this. There is something that Emmanuel just mentioned, which is like what is beyond the invoice. That's very interesting. What is the future of supply chain finance? We have material on our website on some of these topics. So what is supply chain finance today? What can you expect from supply chain finance tomorrow? But more importantly, I would like again to invite you to the conference, SAPICS in June. On Sunday morning, we have a workshop in which we have 3 hours to discuss all that there is to say about this topic with all of you. And on Monday, during the main conference, we will give a speech about supply chain finance with one of the companies that is actually doing it in South Africa, so that we can give more pragmatic experience. So I look forward to meet all of you there. We have a series of events, by the way, as SCF community. We go to Seoul. We have our own event in the Netherlands. And we go to other cities. We have awards. So if you have a supply chain finance initiative already in your company, please submit for our awards. They are already open for this year. And we go to Germany at the beginning of the year. You are all invited to join our events already automatically. Just go to our website and you will find all the information. That is all also from my perspective. And I want to thank you a lot for being here with us today and for all the questions. It was great to see so much interaction. Claire, I don't know if you want to say a couple of words.
No, I just wanted to say I just put the 2 links into the chat, one on the conference and one on the supply chain finance community. We will share these presentations and a YouTube link with you tomorrow morning. And if you just want any more contact details, please reach out to me. And if there are any other questions, quickly put up your hand. Otherwise, I will just close us off this afternoon by thanking both Luca and Emil for their time, for Addendum, for their support, supply chain finance, for their partnership as an affiliate of SAPICS. And thank you to all of our community for participating and engagement, and look forward to seeing you all at the next event and at the conference.
Thank you.
Thank you a lot.
Have a good afternoon. Thank you, Jan, for sharing that link as well with us. Thank you.